Thanks for tuning in to today's podcast. Please remember that all of the information in this podcast episode is limited to general information only. That means the information is not specific to you, your needs, goals, or objectives. So you should seek the advice of a licensed and trusted financial professional before acting on the information. And before you acquire or apply for a financial product, please read the PDS or product disclosure statement, which should be available on the issuer's website. Lastly, please keep in mind that past performance is not indicative of future performance. In this episode, I'm talking to Kyle Frost, an independent financial planner from Sydney's Central Coast. Kyle started a business called Millennial Independent Advice, so I think he is well placed to answer some of my tough questions, such as, how do you use the First Home Super Saver scheme if you're young and you want to get ahead? What are some of the steps that you could take if you have a mortgage, but you don't have enough in your emergency cash savings? And I also asked Kyle, what could a couple do in their late 50s if they want to prepare for retirement in 5 to 10 years? All that and more in this episode of the Australian Finance Podcast. Kyle, thanks for joining me on the podcast, mate.
G'day, how you going?
I'm wonderful, mate. It's my privilege to have you here. I got to tell listeners that you and I had hoped to do this on better circumstances because I'm a big fan of what you do and the business that you've started. It just so happens that I'm tapping into your expertise and your experience now at a relatively uncertain time for people. But why don't you just tell us a little bit about yourself and the business that you've started?
Yeah, likewise. Wish it was so slightly better times in terms of market timing and whatnot. But yeah, in terms of my business, I guess I kicked off probably around January, February of last year in 2019, and always worked in financial advice since coming out of uni in 2013 or so. And I guess always had a passion, I guess, probably come into the industry, I guess, when there was a lot of change in the industry and whatnot. Always, I guess, was quite passionate about, I guess, independence with financial advice. So it got to the stage where I guess I wanted to do things more my way rather than the things the way it had been in the past. So I decided to kick off and do it myself. I guess if there was no, ideal job that I guess could do what I wanted to do. So I kicked off last year, and I guess my business focuses around, I guess, providing independent financial advice, primarily to millennials, but it's not always that case as the, I guess, business has turned out. And it's really like just on a, I guess, more engagement basis. There's no necessarily like ongoing, I guess, advice or anything like that. It's more just saying, well, this is the issue that we're dealing with now. Let's, I guess, work that out. If there's another issue down the track and 12 months later or something like that, we'll deal with that as it comes up and I guess re-engage thereafter.
Yeah, great. So it's to summarize, independent. The name of the business is Millennial Independent Advice, if I'm not mistaken.
Yes.
And although it kind of says it on the tin what you do, you also serve clients across a variety of different demographics and different situations. And I guess we've spoken about business strategy and even before we started our respective businesses, how we would go about, I guess, best executing what we had in mind. And it's only been a few months for you, but I guess it's a combination of your preparedness and the timing in terms of the Royal Commission and all that type of thing, where you've now, in less than a year, you've now been able to, you've been able to grow your business in a way that probably demand exceeds supply. So your incoming inquiries exceeding what you can actually do in a day.
Yeah, I think that, I guess, starting off my new business, because I was always, I guess, going to start off from scratch. I wasn't going to buy another business because that usually, I guess, involves buying commissions and things like that. So that wasn't ever a business strategy. So I was always going to be starting from scratch. And I'll never forget, I grew up on Newcastle and lived on the Central Coast, which I guess is about 2 hours away from Sydney. So that's more like thinking of Geelong for your Victorian listeners, for example. And I guess when I went for my first Sydney interview, so I would have been 23 at the time, I think. And I remember sitting down in the interview in Sydney, and the first thing that the, I guess, quite successful financial advisor said was, you're going to struggle in this industry because clients like, I guess, men with grey hair and pot bellies. So from that moment, I always thought that, well, that I'm young. I probably look younger than I even am as well. I think from that point of view, I always, whether or not it was, I guess, just a perception that I had, I always thought that, well, it'd be tough for me starting a business. I guess going after and trying to attract like your standard financial advice clients who, I guess, it looks like, I guess it's usually like someone, if not at retirement, approaching retirement and with large asset balances. So rather than, I guess, just trying to, I guess, kind of compete against everybody else, I think that was one part of the business strategy. And on the other side of that, I think that it was more satisfaction, I guess, working with, I guess, younger people in terms of you can actually see the results, like maybe on a dollar for dollar basis. Like you're not adding as much value in terms of like if there's large balances and large incomes, like there's probably more strategies from a tax point of view and investment point of view. Naturally, there's potentially more value to be added, but I wouldn't say that you're not changing lives as much. I guess like a lot of these people, they're going to be wealthy regardless of what advice you give. So I guess from a career satisfaction point of view, that was, I guess, why I've always wanted to go down the millennial side of things. And I guess to take a step back, so starting off my business, like it's pretty explicit that I'm obviously, I guess, looking to work with millennial clients. But on the independent theme as well is that unfortunately there's not that many independent advisors out there. So I guess I've had quite a number of, I guess, your typical retiree type customers, which surprisingly have reached out, and also, I guess, just from a few like referrals, for instance, from other financial advisors and things like that. I've been fortunate that I guess those clients are still, I guess, coming to I guess seek my advice, and if I feel I can add value there, I enjoy working with them from time to time as well, with a bit of variety, I guess.
Yeah, for sure, and it's just so good to see that it can be done, and you've done it as well as you have. I'd like to pick your brain on a few things, and in particular, some, I guess, of some advice you would give, just as in a general sense, to people in various situations. So I've structured this episode around kind of what we're seeing in financial markets, but given your expertise is in personal finance, dealing with people one-on-one, handling more complex cases, handling more complex, I guess, situations where people want to do things that are, I guess, obviously important to them, but, not things that you can just get an answer to if you were to, I don't know, go to a website or something like that. But given the situation and the timing of us recording this, being mid-March 2020, the elephant in the room is, are we staring down the barrel of a financial collapse? Is there a market crash? We probably can acknowledge that maybe it has crashed if you could label it as such already. But, what are the implications of that? And I guess going forward, what are some sound principles and strategies people can cling to as they listen to this podcast? So you wrote an article for us recently, which effectively compared compounding from the perspective of Warren Buffett. So we talk about Warren Buffett, and in your article, you say, he started off with X amount when he was 30, but by the time he was 60 or even 50, 99% of his wealth came after that age. And it wasn't so much the decisions that he made after 60, it was the decisions that he made long before 60. And that is such, and as such, the power of compound interest is that the decisions we make today have a significant impact on us later in life. And what I thought was quite neat, that how you tied this together, is you can think of compounding working for us in the case of our finances, which we talk about a lot, but you spoke to it in the case of it having a harmful impact on us and us I guess, appreciating the consequences of the spread of coronavirus and how, I guess, the decisions that we make today influence us in 10, 20, 50 or 100 days from today. So I know this is a long-winded way to introduce some of the questions that I'm going to be asking you, but I just wanted to direct people to that. It's available on our website. I'll provide it in the show notes. So I thought, if you're comfortable, Kyle, maybe I could throw some hypothetical questions at you.
Yep, absolutely.
Yeah. Okay. So I've just structured these questions. I've just kind of come up with them out of thin air, but some of the, I guess, questions that people would want answered right now. So I'm going to give you a hypothetical situation, and here I go. Okay. So a question might be, hey guys, my partner and I are in our 20s and we're looking to buy a house. We have a high growth super strategy. Currently, we're looking at a home and saving $2,000 a month. Should we consider investing that money now to take advantage of the falling stock market, or should we keep saving?
Yep. Yeah, I'd probably say this is probably one of the more common scenarios that I have. So a little bit about my business is that I'll usually, I guess, have an initial, I guess, 10, 15 minute, I guess, chat with people, and there's no, I guess, fee for that consultation. So this is, I guess, when people are calling me up, these are probably the more common scenarios that I have. And I think probably, so over the last 12 months since I've been in business, probably the most common, I guess, question has been, Kyle, I have X $1,000, $50,000, $100,000, 10,000, whatever it may be, in the bank, and I want to invest it. Can you help me invest? Then invariably my next question is, well, like, what are your life plans? What's your plan with, I guess, property? Because that's usually the biggest driver at some point for, I guess, most young people. And invariably it's usually like, well, this is actually my home deposit. I'm thinking maybe in 3 years' time I might be at that point. And it's been quite frustrating because, like, you can only get 2% in the bank account, and that's why they're coming to me, I guess. And I can almost, like, I guess that they get deflated when I guess just talk about the long term, I guess, cycles of the share market, and it's probably not for those like short term kind of goal savings accounts. And so I guess for a lot of the last year, that's probably looked like bad advice to a lot of those people that have spoken to me, and a lot of the time, like, they haven't really proceeded after that call, because it's hard to, I guess I can understand that people don't want to pay, I guess, for advice, but just to keep it in their bank account, for instance. So in that scenario, like, I guess over the last couple of weeks, for instance, those people that I haven't spoken to in 6, 12 months or so have come back to me, and I guess realised that, well, maybe in this scenario, Kyle was right, and probably most of the time I would be wrong in that scenario, just because markets generally trend up. But there's, I think, just protecting yourself from the downside. Is when you have a home deposit and you have to use it in 3 years' time. You don't want to be there in 3 years' time and the market's down 20% like it is at the moment, and that's obviously going to affect when you can, I guess, implement that life goal, I guess.
Yep.
So if back to the question, I guess the normal question would be, like, I guess, when are you planning to go and buy a property? And I would normally say that, like, if you're being conservative, you could say that, well, 7 years, that's on a lot of these products that you're investing in terms of share market products, that's like the recommended minimum investment time frame. And so I guess if you're being conservative, you could say, well, if I need this money in the next 7 years, like growth assets like the share market probably aren't for me. Some people might say 5, and that's a little bit risky, but it's still quite conservative. And I think you can look back to the GFC, when, like, the market declined, for instance. I think it was about 5.5 odd years. Like, if you're invested in like a high growth portfolio, for instance, that if you invested $10,000, it was around 5.5 years that you'd have your $10,000 back. And so that's that's including all your dividends reinvested or distributions and whatnot. So obviously that's an extreme scenario. Who knows if we're at that extreme scenario at the moment? But I guess that's the basis around, I guess, that long-term thinking. So I guess with that in mind, like, you could say, well, the market's down, so it's there's not going to be that, like, based on, I guess, arithmetic, there's not going to be, because you've already missed out on a lot of those losses. I guess by that you could say that, well, I'm taking on less risk now, even though it's easier said than done than I would have been if I invested a month or so ago. But I think that it's still, by doing that, you're trying to, like, kind of, that's an element of time in the market. And that probably wouldn't be something I'd recommend. The interesting thing that you mentioned, like the high growth super strategy, something that has concerned me for some time, and I think I did a blog post maybe a few months or so ago on it, is that there's a thing called the First Home Super Saver Scheme.
Yep.
So I don't know if many of your listeners have, I guess, looked into it, but the government, I guess, has provided an incentive for people to save for their first home through their super, and so people can, I guess, contribute, I guess, up to $15,000 a year into, I guess, your super, and there's tax benefits of doing so, and that's $15,000, so that's included in your general concessional cap of $25,000. So if you're a higher income earner, I think it's around the $105,000 mark, you can't do that $15,000 contribution just because of your standard, like, I guess, employer contributions come in exceed $10,000, for instance. So that's something to keep in mind. But yeah, so that's been a pretty common strategy that it's been quite a lot of interest on it online. And there's good reasons to do so. It's a pretty complex scheme, probably overcomplicates a simple matter in terms of trying to save for your first home and giving people a leg up. But usually there's about $5,000 of tax savings I generally find per person. So if you're thinking of about a couple, they can potentially save like $60,000, and there might be a bit of a leg up in terms of $5,000 each. And like that's a rough figure. It depends on like your tax brackets and things like that. But a lot of people have just put that into super. And so most people's super's invested, if they haven't done anything about it, it's probably like in a balanced 70-30 fund, or it might be, I guess, in a life cycle fund that might be more, I guess, allocated if you're young to growth assets. And something that I've feared is that if a market happens like this, I guess you're going to take those funds out, and you can take them all out because I guess the withdrawal amount's not based on market movements. It's based on like, I guess, a deemed rate effectively that the government gives. So you can take it all out. So it's happy days from a home deposit point of view. But if the market's down a lot like it is at the moment, you've effectively sold down your losses, and that's going to severely impact your, I guess, future retirement balance. So you're kind of stealing from yourself in a way.
Yeah, so you're saying if you put, say, you've got $20,000 extra in there, and then you use that for a deposit at the worst time, like now, you're effectively you don't have the ability to compound that money because you've sold at that time. Do you also incur tax as a result of that?
Yeah, so on the way out, you do get taxed on those like the withdrawals. So we don't. I'll try not to go down into the weeds too much, but the way it works is that you make a concessional contribution, so that's taxed at 15% as opposed to your marginal tax rate at 39%, for instance. And then when you take that out, it's taxed as well, but you get a tax offset of 30% on that. So a lot of people forget about that tax on the way out. And so you usually find is that on the way in, it gets taxed at 15%, and then you can take 85% of your original contribution out, and then it's taxed at the offset. So if you're on a 39% marginal tax rate, so that means your income's between, say, $90,000 and $100,000, that's effectively taxed at 9%. So that's 39% less the 30% offset. So it's not it's not taxed heavily on the way out, but it's definitely something to factor into the calculations on that. But I think when I did the modeling, don't have it up in front of me, that I made the example, like I've modeled what happened with Australian Super, for instance, at the GFC, if you're invested in the high growth option. So Australian Super is like one of the biggest funds in Australia. So I thought I'd just use that in terms of a real life example, in terms of everybody's familiar with that. And I think I did it with the scenario that if you had $9,000 in your Australian Super account before you did this scheme, just from like, I guess, your standard employee contributions, and then you did this scheme and took all your funds out. So you had $9,000 in the high growth option, then you put $30,000 in. So you got $40,000 in there. And then the market goes down, I think it was 20%, 25% or something like that in terms of the high growth option. You effectively, when you take out your $30,000, you've effectively wiped out that $9,000 that you initially had, just in terms of because you've sold down when you, I guess, had it. So that I use that example just because it can get murky, because most people might have $50,000 in their super or something like that. So it's, I guess, really murky in terms of, well, what's my home deposit and what's my, I guess, long-term super savings from an investment allocation point of view. So in that example, like if you think about when you're 25, 30, whatever age you are, if you think about $9,000 of, I guess, super, it doesn't sound like much at that point in time. But if you compound 9% at 8% or whatever long-term return you want to put on that over time, that move like resulted in hundreds of thousands of dollars in difference. So
I was going to say, so what would be the best outcome here? Like, what would you tell someone to do if they are considering using the First Home Super Saver scheme, or would you not say to use that?
There's two ways to do it. So I think that if you're confident that you're around your timeline in terms of when you're going to be buying a home, in terms of you've got a couple of years and you're not going to be in a massive rush at that point in time, because there's admin issues with taking those funds back out as well. So you normally think with property purchases that they normally happen pretty quickly, in terms of it's based on emotion. You see a house you like, and usually things happen quite quickly. And with this scheme, if it's in a super fund, it might take a month or so to get it out, because you have to get ATO approval and you have to go to the fund. Those two institutions generally don't work that quickly. So with that in mind, so if all of that makes sense, and it makes sense from a tax point of view, and you know it's going to be for your first home because it doesn't work for an investment property, for instance, like it can be a strategy that definitely is worthwhile. So if all of those boxes are ticked, I guess there's two ways that you can go about it. You can, I guess, reallocate your investment option within your super fund. So let's say that you're, I guess, invested in a balanced or high growth allocation that's appropriate for you for your long-term super savings. You can like put your $30,000 or $15,000 a year and I guess work out the percentages and then effectively allocate that to a cash or fixed interest option. Because similar to my original point is that for your first home deposit, if you're going to be using it in the next 3-5 years or something like that, if you're doing it outside of super, you're probably going to invest it in cash or something conservative. But all of a sudden, when people use this scheme because they're going to get the, I guess, government deemed rate, they don't invest within super as they would outside of super. And I think that's where the danger lies. And unfortunately, it has in this scenario, which I wouldn't have predicted that it would happen this quickly. But I think if people are buying in the next 6 months, for instance, they could be severely affected by this.
Yeah,
So that's one way to go about it, is to just be conscious of it and reallocate within your super, the percentages. Another way to go about it, which I actually could prefer, but you've just got to find the right super funds, like so you're not getting those fixed fees that work out to be a big percentage of smaller balances, is to set up a 100% separate super fund.
Oh yeah.
So by doing that, you can have 100% separate super fund, and well, this is my home deposit, and there's no other funds here, this is it, kind of thing. And you can just allocate 100% of that to cash or fixed interest, for instance. And it's just a lot cleaner from that regard. And yeah, I would just stress around that there are funds, and there's a couple of industry funds, for instance, that they only charge percentage-based fees. So when you're talking about percentage-based fees, that's good on lower balances, because most funds will charge $78, for instance, as an admin fee, and $78 on $10,000 is 0.78%, which works out to be a big amount, I guess. So that's just something to be conscious of as well. But yeah, moral to the story, I guess, is if you're investing in super with the scheme, is to invest as you would outside in your personal name. Just don't change the rules just because it's within super.
Yeah, okay. So that's great. So we've talked. This is a long, and hopefully the next questions will be quicker. But we've talked a lot about this.
Sorry.
No, this is really good, because someone in this situation is thinking, well, how can I do something with this money, but also get ahead and get my deposit bigger sooner? And you're saying, well, hey, why don't you consider at least the First Home Super Saver scheme? Here's the things that you should be thinking about if you're doing it. And there are tax savings because of X, Y, and Z. Yes, it might be a bit complicated, more complicated than just, I guess, sticking it somewhere with one click of a button. But this is something that you can really investigate yourself and look into the pros and cons of that. So that's really good. And it's not where I thought when I was doing these hypothetical questions, I didn't think you'd come out with such an answer, which is quite
it's often the way with me. So you better be prepared.
No, testament to you, this to your expertise. This is why I wanted to get you on the show, because these are the ways that you can help people. Okay. So I'm just going to skip ahead to the next question, and I'll quote, "Hello, I'm a tradie in my late 20s." So again, a younger person, late 20s. I have a good job, earning $110,000 as an electrician, but I'm not on wages. I'm a contractor only. Will the fall in financial markets impact my finances? If so, what are some steps I can take right now? And I will say that you did share a good story with me on this, but there will be a lot of people that listen to the show, or partners of people who listen to the show, that are in this situation. So I'm really keen to hear what you have to say here, Kyle.
Yeah, so I think, I guess in regards to that person in particular, so if you're in your, I guess, late 20s, you may not have not significant, financial assets in terms of investing in the share market at that point in time. So in terms of the fall in the financial markets directly affecting you, your super is going to be down as a result, but that probably hasn't affected you a great deal in that scenario, unless you hold your home deposit or something like that in shares, as we just discussed. So I'd probably say, obviously the fall in financial markets, that's telling us something about the direction of the economy, you'd imagine. So I think that with all the, talk in the media and whatnot of coronavirus and potential economic impacts of that, I think that would be the thing to be concerned about. So I think there's, in the government stimulus package the other day, support for apprentices and things like that. So the government is around, if the trades in particular, are, conscious around that, just to, support stimulus around that. So I think that the more, concerning thing would be, the economic side of things. So you touched on it, probably Whether or not it's the reason why I got into financial advice, I'm not sure if it was subconscious or conscious or not, but probably when I was younger, so when I was 14 to 16, I think it was, my dad, I guess growing up in Newcastle, it had done quite well, and probably had been over leveraged coming up to the GFC, and was in a particularly I guess industry to be impacted from that. So as soon as the GFC hit, like, income significantly dropped, and obviously the debts and all that continue. So that caused, I guess, financial stress that over a period of time resulted in the loss of the house, for instance, in regards to that. So I think just, I guess, from that experience, obviously I wasn't working at that point in time, or it wasn't, I guess, me directly. Just seeing, I guess, that what, I guess, impacts of, I guess, loss of job or loss of income can have around this side of things is, I guess, coming up to this potential stage, and who knows what's going to happen to the economy. But if there are measures to, I guess, take steps beforehand, I think that there's nothing to be lost by, I guess, being prepared in that regard in a lot of instances. So if, for instance, if you mentioned like the tradie in late 20s on $110,000, it'd be interesting, like if they're, I guess, have I guess cash assets and have a home deposit or an emergency account, like they're potentially, I guess, that they could actually be positively affected by this if they keep their jobs, and if like something economically happens that affects share prices, and that affects, I guess, the property market, for instance, and things like that. Because I guess if you're a net buyer of securities or a net buyer of property, in the future you're going to be buying more of this, you actually, I guess, it's a benefit for you for the markets to decline. So with that in mind, like there could be opportunities there, but on the other side, like, I think that at times like this, like unemployment could tick up. So just preparing that, like my income, I guess I don't know who my employer is, so it'd be just to keep a close eye on that, whether you're an electrician or whether you're in the private or probably public sector is a little bit more protected. Is just at times like this, it's just to think about the scenarios and around your job security,
Yeah.
and how that could potentially impact you.
You know, I think one of the things that you touch on here, and I think it's the important point, but it's probably the one that people don't necessarily think to as much, is the job security. So if you keep your job, that's the big thing, because it's that income coming in, right? So it's interesting, and hearing your experience about how you can lose a house if you're not prepared. So I would like to think that someone earning 110K a year, I'm going to just put it out there. Maybe you're living in an expensive lifestyle, or you live in, Sydney, where prices are more expensive than the rest of Australia, or who knows what. But on $110,000, I would like to think that someone could be saving a fair bit of money, right?
It's horses for courses. I think that from chatting to a lot of people, like on their direct, I guess, financial situation, like I wouldn't necessarily say that there's no relationship between, I guess, your wage or, I guess, your intelligence or anything like that in terms of, I guess, how much money you have or how good you are at, I guess, saving. So
Interesting.
I work primarily, probably most of my customers and prospects come from, I guess, Sydney, just as a function of, I guess, more people there. But I also, I grew up in Newcastle, so I guess I utilise an office space in Newcastle. So I guess see those, I guess, two segments. So in the morning, I might be talking to someone who's in Sydney and doing quite well on $250,000 or something like that, and in credit card debt in Sydney, and then I'll be talking to someone in, I guess, rural Newcastle on $60,000 and they've paid off their home. So there's no relationship, I guess, between that. Obviously, if you have a higher income and you do have those good money habits, you do have the ability to get ahead quicker. But yeah, I'd like to say that there's more of a relationship, and maybe there's a slight, I guess, situation there. Just if you have a higher income, that you do have a little bit of more savings capacity. Yeah, around that, I wouldn't say that there's particularly much there.
Well, I guess that's an interesting point you make, because if you aren't earning $110,000 like this person in this example, or $250,000 in the other, again, the more extreme example, that's good news, because we often look to people that do earn these big bucks and we think, you know what, you should be getting ahead financially. But as you're saying, maybe that's not necessarily the case. But when we talk about it on this podcast, we talk about, the just broad rules of thumb. So we might say someone saving 10 or 20% of their wage is really important, because in this case, if someone was saving 10 or 20% of their wage, that might be, say, $2,000 a month that they could be building up that cash balance if they haven't already done so that, worst case scenario, they do lose their job, at least for the next 2 or 3 months while they're employed or what have you, they might be able to get themselves prepared as best they can. But are there any other steps that someone could take? Like, I imagine someone, if they have, afterpay debts or things like that, is there anything that you can say to people that you should be aiming for this amount of savings as percentage, or is there can you offer something like that, or is it more case by case?
Yeah, it's definitely case by case, and it would depend, I guess, what areas you live in. So obviously, if you're living in, I guess, Sydney or Melbourne, obviously you probably have rent and like higher living expenses from that. And I find that wages in these, I guess, capital cities are high, but not, I guess, a lot higher. So the classic example is if I'm chatting to a teacher in Sydney and Newcastle, usually the Newcastle teacher, it does, like, wages are the same, like in that instance. So the Newcastle teacher can get ahead quite quickly in that regard. Whereas in Sydney, because rent and living expenses are higher, it can be more difficult to save under that. So that's why there's not as much disparity between wages as there are. There's not much disparity between wages, but there can be in living expenses. So it'd be hard to put a blanket on it around that. But yeah, in terms of percentages, I tend not to. I think they can be dangerous to throw out like general percentages, because it comes back to, I guess, people's situation. And probably the classic one is obviously the barefoot investor. Some of the best advice he gives is around cash flow. So it's quite common for people to, I guess, call me up and be really frustrated with their situation and saying, well, I'm missing these percentages in terms of what I'm spending on fire extinguisher and things like that. And I think that they're great percentages to, I guess, start with. But it can be dangerous, I guess, looking at your situation, comparing it to that, just because there's so many other variables. So if you mentioned that if you're a tradie in like late 20s, like, you should have a high percentages, just because you don't have those family expenses and things like that. Normally, if you're a couple, like if you're a couple, you're sharing generally rent, for instance. So you can, if you're a couple, you're sharing probably the biggest expense in terms of housing. You can't cutting that in half. So you can, if you have two high income earning in a couple, they're reducing their living expenses in terms of household expenses, in terms of housing. So there's more capacity there. So yeah, I think it's dangerous putting a percentage in that regard, just because there's so many different elements there.
Yeah, right. That's fair enough. Okay, so I'm going to jump to the next question, or the next scenario, which is, and I'll quote, I have $400,000 on my mortgage, 2 teenage kids at home. I'm about 2 months ahead of my repayments via our mortgage redraw, and I have just $3,000 of cash set aside, so emergency cash, we could say. I have $1,000 outstanding on my buy now, pay later apps. I think my job is secure. Should I start investing, or should I build my cash balance and pay off my debt? So effectively, we've got someone with a mortgage. They've got responsibilities with their kids. They're a bit ahead on the mortgage repayments, a little bit of cash, but also a little bit of, you could say, debt.
Yeah, because I think probably with this scenario is that, thinking about the previous scenario, if they're not a homeowner, for instance, there's usually, if you don't have a mortgage and you don't have that equity, you're probably not as exposed. If you have debt to, I guess, if there's a fall in unemployment, that would normally, you'd imagine, flow into an increase in delinquencies, and that's only going to put downward pressure on the housing market. And that's when you kind of see these, I guess, really bad situations like you saw more of in the GFC, for instance. So in this scenario, I guess just thinking it through, like, I'd say there'd be more a need to be, I guess, more conscious, be more risk adverse in this strategy, and just really think ahead, just because you've got more on the table to lose. So I think with that, like, if you're only, I guess, a couple of months ahead on your repayments via a mortgage redraw, and have cash set aside, like, I'd probably think that you'd really want more of an emergency buffer there, should something happen.
Yeah, any parent could say that $3,000 with 2 kids is probably not going to last very long, right? Particularly if they're at home for a while.
And I think, like, the easy thing, if you're young and you're single, and you can quite easily, it's easier to make sacrifices, and you can live quite cheaply if you're forced to. Whereas if you have a family, your options are just taken away from you in terms of there's I guess more expenses, there's more food expenses, there's more I guess school expenses potentially, and just I guess the ongoing things like that it's harder to I guess pull back your expenses in that without I guess affecting your situation. So I think in this situation it depends as well, like how much equity would be in the property. I guess rather than just being 2 months ahead of the current mortgage. I'd be thinking that like in terms of the cash set aside and the buy now pay laters. I think the buy now pay laters would be a tricky one. Like ideally you'd want to clear them, but if you're in a dire situation, that's probably not as I guess crucial as paying the mortgage in that scenario, like in the short term, obviously. So I think it'd be it'd just be really about thinking about how secure is my employment if I was to become unemployed, like would I have to take a pay cut to try and get back into the workforce. I'd probably think I guess should I start investing, I wouldn't think that would be on the table at this point in time, just because if you're doing that, you're obviously I guess taking away from your cash to be able to withstand like an emergency savings account, for instance. So I think like in this instance, another strategy could be whilst times are, I guess, still good economically and like the property market hasn't been affected and you're still in a job and have serviceability and whatnot, it could be worth chatting to your bank or chatting to your broker and just seeing if there are any options out there, I guess, to refinance and I guess take more out of the, I guess, equity of the house and keep it in the offset account. So by keeping it in the offset account, you're not going to be paying any more interest, for instance. But under that scenario, at least if something happened, you can use those funds in the offset account to get over like a short-term funding, I guess, deficit to keep paying those repayments, so you don't have the bank knocking on your door.
Can I jump in there? Can you just repeat that again? So you're saying people, let's say this person has $400,000 on their mortgage. Their house might be worth $600,000. So there's $200,000, the difference there in equity. And what are you saying they can do? They may be able to do with that?
Yeah, so if they're still employed, for instance, so most banks, if you can service the loan, is you can, I guess, take funds out of the property. So most banks will lend up to 80% of the value of the property, and you can kind of, I guess, take that out, like I guess an equity release out of the property, and keep that in the offset account, I guess, ready under that scenario. And I think that the reason why it's to do it now rather than later, because usually, like for instance, if the property market went down, that 80% is of I guess you lose equity in the property, so that 80% is based on a lower property value, and also at that point, like you could be out of work, and like no bank's going to, I guess, refinance it at that point in time. So it'd be a matter of probably a broker would probably be best to chat to in this scenario, because they've probably got a more broader range of the different lenders. But I think it's not going to be available to everybody, and it's not going to be available at every bank, but it'd definitely be a strategy worth considering.
Yeah, so it's something that if you're going to do it, perhaps it's best to start thinking about it now. I imagine there are plenty of people that listen to this podcast that think, I've got a house, I've got a mortgage, what can I do? Because you kind of feel frozen. You've already committed to a house, you might have kids on the way. What is there anything that I can do that frees up cash? Well, this might be something. So that's a really good piece of, I guess, advice there, just for people to call their bank or call their broker and just ask the question, right?
And I would stress that I guess you'd need to be, I guess, quite conscious of what's going on as well, and quite disciplined. For instance, if you, I guess, go and take funds out of the offset account, if you take equity out of the property and put it in the offset account, like generally under that scenario, people might feel richer, for instance, and they might, even though this is an emergency account, they might feel more inclined to go and spend that on other things. And like that's defeating the purpose of it all.
Yep.
So it's a bit of a, I guess, a niche strategy, I guess, under that scenario. And it's really, I guess, just thinking ahead and, I guess, a risk mitigation strategy. Just to make sure that it's not going to work against you and that you're not going to get tempted to put those funds into the share market, for instance.
Or go on a holiday or something like that.
Yeah, I think that's probably the biggest thing that, so banks, like offset accounts are great, and banks, I guess, will love to, I guess, say that how good they are for the borrowers, which they definitely are. But there's a bit of mental accounting going on, and I suspect that it could work in the bank's favour. So for instance, if you have $100,000 in an offset account and versus 100% in the redraw account, you're probably going to feel richer even though your debt position, your net debt position is exactly the same. You're probably going to feel richer if you have the funds in the bank account and more likely to spend that as opposed to having in the redraw, because you feel like, well, I'm actually borrowing these funds, even though it's exactly the same outcome. So I think that's the biggest trap with offset accounts, as amazing as they are from a more tax point of view than anything else. That's another issue, I guess, is that they're just from a, I guess, mental point of view, I feel that you need the discipline around it to make sure that you're not going to spend more just because of the offset account, because then it really defeats the purpose in that regard.
Yeah, just, I guess, know why you're doing this in the first place. And it's definitely, in my opinion, if you are accessing this because you are worried, it's not okay, in my opinion, to then go 2 months down the track, use that money, and then in a way that, I guess, increases your risk, because the reason why you do it is to risk off, not risk on, which makes
Absolutely.
sense. Okay, so
I think the last point I'll add to that, sorry, is like if you're in a really good spot and you have a lot of equity, and you might have, I guess, cash savings in an offset account, like people might be, I guess, tempted to invest in this situation, and that may well be a good strategy. So usually I find that most people, when they come to me and they're looking to invest, and they've got their home loan and they're doing really well and getting ahead, and it does make sense to invest, is that they'll just invest, I guess, cash from an offset account. And that's usually probably not the best strategy. Just because if you have a home loan, which is a non-deductible debt, and you have an offset account attached to that, if you take funds out of that offset account, you're effectively increasing your non-deductible borrowings. And so you're going to pay interest on that, and you're not going to get a tax deduction on that interest. So in that scenario, obviously there's a bit of debt structuring and whatnot to chat to your broker about, broker or bank in this scenario. But usually a better strategy, even though it goes against it, it's exactly the same, is that you'd actually go to the bank and ask to borrow to invest, in terms of, I guess, utilize the equity in your home, so you're still borrowing at those cheaper rates, and it's not like a margin loan or anything like that, whereas there's the additional risk with margin calls and things like that. But you, I guess, set up a separate facility for the sole intention of investing, and when you borrow to invest, you get the tax deduction associated with that. So that's probably the biggest mistake that I'd find that a lot of people, I guess, who go and invest, is that they just invest cash, and you're going to pay interest in any case. You may as well get the tax deduction for it.
So could someone who has, say, $300,000 of equity in their home, could they set up, when you say a separate facility, in the bank's eyes, is that secured against the property because that's where the equity is?
Yeah, so it's still secured against the property, so no banks are going to take, I guess, shares as security in that scenario, because you're talking margin loans in that regard. So yeah, it's still, you need the equity in the property to do that. Sometimes you might need to create the equity effectively by putting like the offset account into the loan and then reborrowing it. And there's probably a couple other things to consider then. Where probably, I guess, saying to get advice, obviously, it's important. So it would be worth, I guess, just making sure you're aware of the implications of doing that, because there could be scenarios where you just have to be careful.
For sure.
Around that. But yeah, in that scenario, is that if you think about it, let's say that you have a $300,000 loan against a $600,000 property, you could go to the bank and say that I want to borrow $100,000 in a separate facility here. Then you have, I guess, the $300,000 home loan, which you had previously. Then you had a $100,000, I guess, separate loan there, which has gone in, and then you can invest that into the share market, for instance. So if you're paying interest at 3% on that $100,000, that's going to be a $3,000, I guess, tax deduction per year. And then, so if you're on the 39%, I guess, marginal tax rate, you'll get, I guess, 1/3, or you'll get, I guess, $1,200 or whatever that works out to be in terms of tax savings per year. So if you think about that over over the long term, like 10 years or so, if you're thinking about those tax savings every single year, I guess that's where the value in the strategy can be, rather than, I guess, just paying interest anyway and not getting the tax benefit of it if you're going to do it anyway.
It's not just 1 year's, interest or deduction. It's multiple years of savings. So that's obviously compounding, as we talked about at the top of the show, is really important. Kyle, I'm going to direct your attention to the final one, which is something that I kind of modeled off people around me. So these conversations that I have had recently with people asking very similar questions, and I'll quote, "My wife and I are in our late 50s. We plan to retire in 5 to 10 years. Our super account is showing a loss of $300,000 over the past 6 weeks combined. Should we move from high growth to mostly cash? We have $100,000 outside of super in emergency cash, and we're virtually debt free, meaning we have enough cash to last us about 1.5 years, even if we lost our job. So we've got an older couple here. They're in a growthier strategy, but they said that they're down $300,000. They've got a good base beneath them because they're preparing for retirement in 5 to 10 years. What would you say? Maybe it's time to take some risk off the table. What advice would you have for someone like in this situation?
Yeah, so I think when you're around this period, and I think it's probably not as appreciated as it should be, is that when you're, I guess, coming up to retirement and in the earlier years of retirement, I guess your actual, retirement outcomes are severely impacted more so than ever by the investment returns around that period, just because generally you're going to have the higher balance around that. So you're, more likely to be affected by that. So for instance, you can relate it back. If you have $30,000 in super and you have that investment horizon now, that's not going to, affect you too much over the long term, as opposed to naturally bigger balances. So usually there'd be that's something just to be really conscious of, that it's probably more important to think about your investment strategy when you get these bigger balances rather than when you have a lower balance. So if you're already you're already in high growth, which I would question coming up to retirement, if that was the 5 to 10 years to retirement, if that was the appropriate investment option. But if you've already done that, in terms of you've already got those falls, it probably wouldn't be without giving advice, probably wouldn't be the best strategy to go to cash. I think probably, and it's quite tempting to do so when you can have all the best investment fundamentals and investment rules, when the markets are good in terms of your strategy, in terms of being a long-term investor, that's very easy to say. But when markets are at points like they are now, it's easier said than done to do what you originally were going to do. So I think probably I started in the industry in 2013. So I was in school and uni when the GFC happened. But what I found is, starting in 2013, the markets had just about recovered from their falls. And so when I started, there was a lot of new clients coming to the firm that I was working at the time with significant amounts of super just invested solely in cash. And so what happened is that they might have, let's call it $1 million to keep it round. They might have had $1 million at the start of the GFC in 2007, 2008, when it started to crash, and it went down to, let's say, probably, if they were in a high growth fund, maybe $600,000, and they held on for as long as they can. But it just gets to the point where you think, well, this is going to go to $200,000, and that's when the fear, and obviously people get tempted to change their allocation at that point in time. And then they're in cash, and then the markets recover invariably. And then once the markets recover, that's when they feel, confident to enter back into the market. So with those examples in mind, so 2013, the market had largely recovered. And people are coming to me and they've pretty much missed all of those, rises back up, and now they're investing. So that turned out to still be a better strategy than not, because from 2013 till pretty much now, the bull market continued after that. But they would have been significantly better off because they missed out on those initial gains. So I think with that in mind, using that example, it probably would be I'd suggest, or I'm suggesting to all my customers, even though it can be tempting to think that where the market's going and that it's going to go down further. No one's been able to do that over the long term, and you have to be right twice, in terms of, you have to be right that now's a good time to sell in terms of it's going down, and then you have to be right a second time in terms of you need to know when to buy back in. That's why it's particularly hard to time the market. And I think there's an interesting there's a financial advisor, consultant, and he has a particular skill at just drawing sketches that explain complex issues in really simple diagrams. So I'll link you to that for the show notes, Owen.
For sure.
What he does is he just draws your market cycle, in terms of you've got your peak and your troughs, and so just think of a drawing like that, and at the top, it says, I guess at the top of the cycle, it says greed, buy. And then at the bottom of the trough, it says fear, sell. And then it says repeat until broke. So just thinking of that in mind, that everybody wants to buy when the market's at the top, and everybody wants to sell when the market's at the top, at the bottom, sorry. And obviously, if you do that every cycle, you're eventually going to go broke and lose your investment portfolio. So I think, yeah, I think it's easier said than done at times. But just, I guess, thinking about your, I guess, long-term plan, and not diverting away from your original plan, because that's usually the biggest danger, is changing your, I guess, investment strategy mid-cycle, just mainly because of emotions.
Yeah, I like how you brought that
sorry.
behavior gap in, because it's from behaviorgap.com. I love the chart. I've got one pre-prepared, so I'll pop that in the show notes. Yeah.
And you added one other thing there. So like in terms of the like $100,000 in cash. So I guess like some people would be tempted to, I guess, put that into the market, for instance, and maybe contribute it to super, and I guess buy at low prices. Yeah, I think that'd be a case by case. It'd be interesting. Like you'd obviously have to factor in, like thinking back to that previous question, like your emergency savings and things like that. But yeah, that would be something to keep in mind, whether if you do have investment capability and you have the, I guess, emotional, I guess, stomach to put that into the market, that could be a strategy. And probably one thing that I'm doing, I guess, with a lot of customers at the moment is that I think probably dollar cost averaging is really valuable at these points in time. So if they weren't already, like in terms of obviously before this, I think they are, particularly now from an emotional point of view. So like, for instance, I was meeting a customer literally on that day, I guess, when the market, 2 or 3 weeks ago, when I think it lost 3% or whatever it was, when the coronavirus started to impact markets. So we were in a meeting in the morning, we were talking about all of like market cycles, long-term investing, dollar cost averaging and whatnot. And then I guess I got out of the meeting, saw the market outcomes and things like that. And then I guess chatting to that customer after that, she was a lot less keen naturally to go and buy into the share market, and the market had gone, like it was a few days later, and the market had gone down further by that point than she was previously. And if you think of scenarios like that, if you look at the arithmetic behind it, now's a better time to invest than it was a month or so ago, when she was very, I guess, keen to invest. And even though we were going to implement a dollar cost averaging strategy, and we still are in all likelihood, like she's a lot more, I guess, cautious now, and naturally she's like, well, like, let's just put it on hold for the moment and let's just see what the markets do. But I think trying to take away as many decisions in terms of allowing your emotions to drive your decision as much as possible, I think there's a huge amount of value in that. So if you set up a system in terms of, who knows what the time frame is, but if you say that I have, let's say, call it $120,000 to keep it round, and say that I'm going to put all of this into the market over the next 12 months, I'm going to put $10,000 in every single month over the next 12 months, and just, I guess, averaging out that cost base over that time, like that's a way to take the decisions out of your hand, and not to get to, I guess, change the strategy based on where the market is at that point in time, because it's very tempting to do so. And obviously you've got to factor in like brokerage and transaction costs and things like that. But yeah, there's a lot of value in terms of, I guess, just trying to take as many decisions away from yourself as possible. And along that same line is that if you have a strategy, like there could be value in, well, I'd say there would be value for a lot of people to, I guess, document that investment strategy. And even if like you can write it down, or potentially even like record a video for yourself to revert back to, and say, well, this is my strategy, this is why I'm doing it, I'm a long-term investor, over the long term market capitalism works, and markets are going to reward me for the risk that I'm taking on. And just to revert back to that at times of distress, you can say, well, maybe I will just put the investment back in the drawer. Or I was talking to a customer the other day, and I said, there's just go and palm your keyboard 3 times and lock yourself out of your brokerage temptation. Don't do that necessarily, but along those lines, just try and take as many of the emotions away from it as possible. You'll probably have better outcomes. And yeah, probably one last point, so I'm talking a lot, obviously. I'd say that if everybody invested like they invest their super, I think that'd be a lot better off. Maybe not at times like this, people are still tempted to, I guess, change their allocation. But I find that a lot of people, particularly young people, you don't really think of super very often. You don't, I guess, think of making changes to it and things like that. And sometimes that's to their detriment. But I'd say that that's, I guess, to the benefit of a lot of people because they don't make changes to it. So I think if everybody, I guess, invested in their personal names as they did in super, I think they'd probably have better investment outcomes and probably a more pleasant investment experience as well.
It's interesting, right? Like, I found when we did studies in the past of really good investors, what we found is that the best investors make fewer decisions. And I don't think that's any coincidence. I think it's because they tend to make better decisions the more they think about it. And I listened to an interview with Amazon founder Jeff Bezos, and he said he never, ever takes a meeting in the afternoon because he said, my job as the leader of a company is not to make many decisions, it's to make a few and to make them as best I can. And when better to make a decision than in the morning? So he schedules all of his meetings for the first thing in the morning and none for the end of the day. And it's a simple idea. He wants to be well rested. He wants to make good decisions. So even if something is pressing, he still waits till the next day to schedule it because then he knows he'll make a better, cleaner, more pure decision. And I think if people think about their investing, not so much as making many little decisions, but I made one or two major decisions, like committing to investing for a very long period of time, as you say. I mean, a video log of your investing strategy is a new one. I haven't heard of anyone doing that, nor telling a client to palm the keyboard if that's what's best. But sometimes
I haven't done it. I didn't put it in the statement of advice. So don't worry about that.
But you're right. Sometimes having friction between you and the trigger is an important thing. Like, don't shoot first, ask questions later. Ask the questions now. So you set yourself on the long-term journey to wealth creation because you're going to come across these periods where things aren't as clear cut. And those types of knee-jerk reactions are actually working against you. Kyle, I'm conscious that this has gone on for a long time. So I want to, before I let you go, I want to ask you if you have, if you could, you don't have to have 3, but maybe you've got 3 simple steps that anyone could take right now during, this time of uncertainty to just take stock of where they're at and maybe put some steps into place to put them on a good footing.
Yeah, so would you be thinking, I guess, echoing some of my points, like from an investment point of view or from I guess, risk mitigation work point of view? Or
I think one of the good ones that you come up with, like, for example, is your behavior trick. Maybe now's not the time to be looking at your brokerage account, right?
Yeah, 100%. I think that's probably the danger. Like in terms of like the information flows, probably I guess quicker than it ever has been. And in the past, for instance, if you had a share investment, like I guess the technology for super funds was probably a lot less, like a lot poorer in terms of if you wanted to make an investment change, it was probably like filling out a physical form rather than just logging onto the app and changing it there. And similar with, I guess, brokerage accounts, maybe like you might have had it through a financial advisor or a stockbroker back in the day, and just like I guess there's that I guess resistance and there's that extra step to I guess call them up and I guess get the advisor to implement that. Whereas a lot of people now, I guess, like I'm a massive fan of I guess ETFs and holding I guess investments that way. But I guess at times like these, it could be to your detriment just because it's so easily at your fingertips. So it's just a matter of, I guess, being conscious of, I guess, your behavior shortfalls that we all, like, pretty much everybody has at times like these, I'd say, and just trying to put, I guess, steps in place to try and do that, and whether or not it's, I guess, finding an investment buddy or I guess chatting to your partner or something like that, and just being really open and like before you just say to yourself, well, if I'm going to make a investment decision, let's I know that my mate that he invests in the shares, let's I guess team up, and like if we're going to do anything, just say that, call each other up and say that, just talk each other down. I think in terms of revert back to our strategies and things like that. So I think it's at these times it's more an emotional game than actually choosing the best investments and things like that. And yeah, I think that just being aware and putting strategy in place would be around that. And I think at times like these, like as I say, like I'm a big fan of ETFs and like obviously mainly I guess cheap fees. That's the thing that I'm the biggest fan of, I'd say, which is a function of ETFs and index funds. But I think that at times like these, there could be like actually emotional benefits of some active funds. And the reason why I say that is that if you're looking at like Vanguard Australian shares or VAS or look at the code. Like, it doesn't mean a lot to a lot of people, and you know that I hold 200 companies or 300 companies in the form of VAS, and it doesn't really mean anything. Whereas if you look at like active managers, for instance, is that they usually like they can show you their portfolio, and they probably have like stories, and you can say, well, they own this really good company. So in terms of that, it can be tempting at times to just think of the share market as just a number on a board. And when you look at index funds, that's probably, I guess, that kind of encourages that way of thinking. And on the other side of that, I think I probably have a bias towards index funds, no commercial bias, just a bias just based on the fundamentals around that. But I do certainly at times like this, I acknowledge the benefits potentially of active funds in terms of if you know that, well, my active fund holds 20 of these, I guess, amazing companies. I might feel more secure about that because I can relate to, well, if Microsoft isn't around or Apple's not around or Commonwealth Bank's not around, like the world's going to be a bad place. Like that's going to be a different world to what we live in now. So like just relating it back to that, and that'd be another thing. Like, because you can still do that if you're invested in index funds, and because you're still exposed to these companies in one way or another. And would just be too, if you're going to make a trade, well, look at the actual companies that you're most exposed to. And I think so if you're in the form of VAS, like, so your biggest holding effectively is Commonwealth Bank. If you're looking at like an international ETF, like your biggest holding is going to be Apple and Microsoft and Amazon, all these companies. So if you think that like that's what's driving your investment return, so I think that looking at it from that point of view, that could be a way to I guess make you feel better about your investment portfolio as well, and that flows through to super funds as well. So if you're looking to make investment allocation changes to your super fund, most super funds will like show their underlying holdings of their investments. So it's just about digging around on their websites, and they'll actually tell you that these are our biggest shareholdings, and that could be a way to make you feel better that I'm not just buying a bit of paper that's moving around on a board, that I'm buying a company, and if they're going to keep going down, then at one point or another, people are going to want to buy these companies at these cheap prices. So it kind of puts a resistance on it.
Yeah, I think you hit it. You've given some great tidbits there. If I was thinking about that, you've got, just to clarify, when you're talking about active funds, you're talking about fund managers who make decisions over which stocks to include or not, as opposed to an ETF or an index fund, which kind of buys the entire market or parts of the market according to a set of rules. I guess the key message there is just know what you own and why you own it. And I got asked yesterday, who invests super? And it's a common question. I don't want to, begrudge anyone who doesn't understand investing, but super is just invested in companies. Most of it at the end of the day are in different types of assets that are designed to go up in value over a long period of time. And for me, you can dig around if you want to look at all that type of thing, but just remember that you are invested in something like a business. And if you do indeed, as you said, believe that capitalism works, you believe that people should be rewarded for hard work, for innovations, for these types of things, then that's actually a good thing.
100%.
Kyle, as we come to the end, I just want to reassure people and say, this is uncertainty in the financial system. It's obviously looking pretty grim right now. There will be some tough times ahead, as there has always been. It's inevitable that we have market crashes and corrections. And I got told this morning that uncertainty is the only certainty when the market crashes. So, that's, I guess, what we're seeing now is a lot of this uncertainty come to the fore. So, maybe we just have to be more comfortable with being uncertain if there is such a possibility. But, we want to remind people, you and I have talked today about a lot of these financial situations, but perhaps, it's more important, and it is indeed more important for people to be thinking more so about making sure you're safe during this uncertain time, keeping yourself, distanced if you need to be, and just keeping up to date with all of the latest guidance on the coronavirus outbreak. So we'll provide some show notes on that. Kyle, I understand, and correct me if I'm wrong here, that you do a little bit of work from home, right?
Yeah, primarily. So I think more and more, probably working more and more from home in terms of like doing meetings after hours and stuff. That usually suits more for my customers, and that's probably I guess going from being an employee at an office for a number of years to working from home definitely was a challenge. Moving from it, and you got to find hacks around that to make it work for you from a productivity point of view.
Yeah, so I was going to end on a lighter note, because I know a lot of people, particularly those who work in white-collar jobs or can work on their computer remotely, chances are over the next few weeks, a lot of these people will be asked to work from home, and perhaps many of them haven't worked from home before. So what, if any, tips can you share with working from home? How do you stay productive at home?
Oh, I'd probably say for me personally, it'd come back to sleep. So I'm probably like can get obsessed with a lot of things, and it can be tempting to keep researching things and keep I guess working on my business and working for customers and whatnot. So I think that it gets to a point that I guess you can be tempted and you can say that I'm only working like I guess the less I sleep, the more work I can get done, and having that kind of mindset. But it gets to the point where you just lose productivity altogether. So I think that the benefit of working in an office and having a job where you start at 8:30 or 9 o'clock is that obviously you've got that forced, I guess, start day and the accountability around that. And also you've got the end clock off. So you've got like that, I guess, end time.
Mm.
So I think it's really around, I guess, just having a routine around that. In general, but especially sleep and making sure that I guess you're not working past a certain time, and I guess figuring out what's working for you. But yeah, I think making sure that you're still getting those 7-8 hours of sleep, and
Mm-hmm.
yeah, a couple other things probably. I guess separation of workspace, and I find for me getting ready as well.
Yep.
I find that I'm probably more productive. I get ready, I put shoes on, and like just I guess walk down the hallway. It seems weird, but just little things like that. And it's horses for courses, obviously finding out what works for you. But
For
definitely
sure.
around the routine and separation. And I think that like you and I are in similar boats to this. I keen to hear your. I think we've spoken about it before as well. Keen to hear your thoughts as well.
I agree with you. You know, to keep your routine. If you're going from working in an office, you would normally get up in the morning. You would first of all hopefully get changed into some clothes. So perhaps maybe don't make it your trackies or your PJs. Actually get into something that is, you know, jeans or something that requires effort to get into, because that forms part of this separation between work and home life. But when there's no physical separation, you have to find a mental separation between the two. So clocking on and off, you know, you start at a certain time. Maybe you go for a walk in the morning, and then you come back home and you settle in at 8:30, 9 o'clock like you normally would. And at the end of the day, maybe you do the same thing. You go for a walk, or you go to the gym, or you have some sort of separation, or you go for a run or something. And the final one is, if you've got kids and a partner, just because you're at home for the next few weeks potentially, that doesn't mean that you're home to have fun. If you are working and you've got the computer there, you should find a separate space, and you should let them know that, hey, I'm working during the day, so please respect that I actually have to focus on this. And I think all in all, the next few weeks, maybe months, that'll be a good way for people to go about it. But
100% agree.
Kyle, once again, mate, thank you for joining me on today's episode, and to learn
Thanks for having me.
No, mate, it's my pleasure. And I think our listeners are going to take away a lot from this, especially those that I'm thinking have a home, they've got a mortgage, how they can manage that, and just insights on tax and all the rest of it. So if people want to find out more about you, where can they do that?
So I have my probably the easiest place would be my website. So the business is called Millennial Independent Advice, but that's pretty wordy, and people always misspell millennial. I generally find. So my website is miadvice.com.au. So you can think of my advice with an i.com.au. That's probably the easiest way, and particularly if you're probably going to, I guess, make any sales, please get in touch with me or any person, I guess.
Yeah, to talk people back off the plank of moving to cash, perhaps. Yeah, absolutely. Well, Kyle, once again, mate, thanks for reaching out and for coming on the show. I appreciate your time.
Awesome. Thanks so much, Owen.